Wednesday edition of My Stock Scanner Live starts now. We are going directly to the English edition because Hans Henrik has the day off and therefore no Danish edition, especially because Liam's Danish is really rusty. So we won't do that. We'll crunch the
English,
numbers
isn't it?
anyhow. It is,
Yeah.
it is. We'll crunch the numbers and we'll ask the only questions that really matter. Does the stock have a quality? Does it have an upside? And is the timing right? Liam, since you're on hold here, I'm going to ask you about the 3-point playbook portfolio. Sits at 1.1 in the negative, in the red, and we were up 0.3% yesterday, but we are on the sideline. We have a lot of cash at hand and not very heavily invested. Shouldn't we be out there buying?
I'm not sure buy the dip is quite the right thing to do at the moment. I think we need we basically had one data point, which is, the ceasefire might be open, and then I don't think Iran has got the same idea of that. So we're going to wait and sort of cool our heels a bit and see what happens next week or two.
But there's no doubt that if we looked at the firework, and I'm talking in the markets yesterday, we missed out on a few stocks. There was a lot of stocks that went up by 2 digits yesterday.
Yeah, there were, and that's the price of sort of being diversified and keeping your money safe. We're far right at the moment. We're in more capital conservation mode than we are. Let's go out and sort of take some big hitters and see what we can get out of it, because there's risk to the downside as well.
Once again, welcome to My Stock Scanner Live, where we stay sharp when markets are split in different directions. And I said there was 2 digits upsides. There was definitely also stocks that went down by 2 digits yesterday. Of course, that was in the energy sector due to the ceasefire. But do we have a ceasefire or not? Does it hold up? We'll take a look at the small signs that are showing at the moment. We're also seeing a striking divergence in the Nordics. Sweden surging higher while Norway dropped sharply yesterday, led by, of course, the energy stocks, but also Yara International, of course, were pulled down yesterday because of prices on fertilizer. We'll also take a look at the uncertainty in the global consumer space as Constellation Brands, that's the company with Corona and Modelo beer, they pull their guidance. What does that mean for names like Carlsberg in Denmark? And then the market for the diabetes $190 billion market is back on. In that sense, there's some things happening that pit Novo and Eli Lilly against one another again. And Meta steps up in the AI race. Let's get started. We have a busy show for you. First of all, number of the day, we're going to use the one from yesterday because we never got to the result of it. It's 3,861 out of 10,000. What does it mean? We'll tell you later. But first, let's look at the Hormuz Strait. It's not a live picture, I can tell you that, but it should be how it looked right now with peace, calm seas, and tankers going out. But Liam, that's not really happening, is it?
I think they're probably going around in circles rather than anything else. There's the ceasefire. I mean, it's still technically there, I think, at the moment, but we haven't seen any evidence of any more ships going out. There's about 10 or 15 going out every day at the moment, and they are effectively going through a toll booth in Iran. Iran are charging somewhere around $1 a barrel for oil at the moment to get out, which I think people would very happily pay if they could do it. The issue you've got is that if a European or a US or someone actually pays it, they're actually breaking sanctions. So in the past, the US have refused the ability for these ships to actually dock in the US waters before. So that's a danger that people are going to look at. Whether they can get insurance or not for these big boats and the cargo they're carrying is another matter as well. So we don't see much happening over there at the moment, and they certainly need to go the extra mile now to get something ratified, something on paper.
But if we look at the market, they kind of celebrated like it was 1999. We
They did.
saw them shoot up yesterday and we saw oil prices come down in a hurry. We looked at the oil prices, they basically dropped $10, $15 per barrel. So the $1 they pay in toll, that's nothing.
It's not a huge amount, is it? They are on their way back up again today. Not quite as fast, but you've got a 5% rise in the West Texas crude here, like crude oil futures. And so, yeah, I mean, the market's pretty much red. If I just scroll up, you can see we've got Norway, because it's more of an energy focused market, is up 2%. That took a battering yesterday, like you said, but everyone else is in the red today, which sort of you'd expect after a day like yesterday, where you got some profit taking. Yeah, and people are thinking, okay, now it's time to get out. Really is. But yeah, the energy market has taken a bit of a battering at the moment. Where it goes, that depends on what happens with the ceasefire.
But then let's look at the Norwegian market and the Swedish market in the same context, because as you said, Norway took a beating yesterday. We had the full market, the OBX, went down by 3.16%. At the same time, the OMXS, the Swedish market, went up by 4.25, almost 8% different. But of course, it's about what stocks are in those markets. If we look to Norway, of course, this company kind of bore the heavy load yesterday in the negative side, down by 12.12%. Whereas if we look to the Swedish market, Volvo were up by almost 8%, but a lot of the heavy industry index in Sweden, like ABB, Sandvik, Atlas Copco, and stuff like that, were up 5, 6, 7% as well.
Yeah.
Is that how it is?
It's a knee-jerk reaction. So all these stocks that went up yesterday so much, Volvo and people like that, they're heavy industrial players. So they use an awful lot of energy out there to actually do their jobs and produce their cars and produce everything else that the companies do. So the high price of energy actually weighs very heavily on their bottom line, and that's what we trade on. We look, we want a company to, we buy into earnings when we buy a company. We buy their future earnings. We're going to get out of them either in increase in share price or dividends or share buybacks or something like that. So that's where sort of the relief was in there. There's also a fair amount of recession sort of creeping into these numbers as well, where if the energy price, it used to be back in 2008, if the oil price went above $120 for any prolonged period of time, then you were almost assured a recession afterwards, because all the companies started sort of cutting back on everything they were doing. That probably gone up now to $150 to $180 or so. So we're not quite there yet, but that was certainly a fear.
No doubt that Equinor took a beating yesterday. So did Var Energy in Norway, and then Yara, the fertilizer stock, also took a beating. One stock that I'm going to bring up, and I know it's a bit of a sore thumb for us in that sense, that Norsk Hydro, because we went into that stock, we also was sent out of it, and let's just be honest, Liam, we missed a profit there. There's no doubt.
We did, and these things happen. Yeah, that's what happens when we have rules, and we've got to stick by them, because actually, when you look at the sales that we have made based on these rules, we've actually saved ourselves far more money coming out of stocks than we have actually cost ourselves in these sort of things happening. But if we just look at TradingView very quickly on Norsk Hydro, we came into it somewhere around here, 10th of March, 11th of March. We thought it was a brilliant play, I must admit, and I think it still is. Norsk Hydro, they certainly the Norwegian side of the operation, they make they smelt metals, and it's incredibly energy intensive what they do, but they actually have a huge amount of hydroelectricity that they own. That means that actually any increase in oil or anything, or liquid natural gas, that doesn't actually affect their operations too much. So that's why we thought we were being really, really clever finding these guys. But the stock dropped anyway. It actually dropped below the 50-day, and it was a big gap down here that you can see. That's when we came out somewhere just under the 50, and then it promptly sort of rose up again and shot up afterwards. That's what happens sometimes, but we still picked a really high quality stock. If we just look at the 3-point playbook just very, very quickly, high quality score, earnings per share going up, and the analysts loving them, peg ratio really, really low. It's still a great stock, and we may still go in. It's gone up 16% from the bottom, or from where we actually picked it, I think. But that, from a valuation point of view, it's a quality stock. From a valuation point of view, we're seeing a worst case scenario from yesterday of 12% upside. So, and a best case scenario just to the end of the year of 70% or so, and actually even more if you hold into next year. So, yeah, our members will get an email, when we've added it to our educational portfolio. But yeah, we really, really like this stock.
But right now, if I look at it, if we stay within what we teach people, and that's part of what we do, is that it's hugging the green line right now, which means that's the bull case. And when I look at the
Yeah.
chart you have right now, isn't that meaning that we are staying out of it until they have a little bit of a retracement?
It can do. To be honest, it really depends on what the upside is. So, if you're a lot of the time when a stock hits that green line, it's right at the top of its channel, and there's not that much room to go up because it's already hit that price that we think it's going to go to. In this case, this green line and all the lines are so steep that there's still a good upside in it, even if it keeps on hugging these numbers. Even if it dropped back down to the red, by the end of this year, we'd still make 12%, and that's our worst case scenario. And the analysts think it's going to drop 20% this year from this particular point. So we sort of disagree with them.
One thing that the market reacts to, that's uncertainty, and we have plenty of it, and basically have plenty of it the last year ever since Trump became president. And that's not a political statement. That's just a fact that the market really disagree with anything that's very volatile. And I'm going to bring up a story that we read this morning, and that's Constellation Brand, the U.S. maker of beer, Modelo, and Corona, all of a sudden dropped their guidance for 2028 due to uncertainty, due to that volatility. And I brought up Carlsberg because we looked at it yesterday and said it could be a buy.
Yeah.
Are we saying not so fast now, or what's our reaction here?
This is why we're cooling our heels with not sort of jumping into these stocks, because a lot of the certainly the beer stocks are very open to the prices of CO2, and that's normally a byproduct of fertilizers. So and 20%, 25% of that and worldwide is generated from the Middle East because it's quite energy intensive. So these companies have suffered quite a lot. They've also, Constellation Brands have also got the tariff issue. I was reading a report yesterday before I saw Constellation Brands, where in Trump's first term he put 25% tariffs on wine and beer, I think, from Europe, and that took a calendar year to come through as inflation numbers. We're now a year on from the tariffs coming in. So I think this is what Constellation is starting to talk about here. If we just look at their stock very quickly, you can see the numbers have dropped from what we've got in the system at the moment. The numbers, the analysts' expectations, which are these yellow lines, haven't actually updated quite yet. But you're effectively talking about still quite a large increase from the loss that they had last year into a profit of $11 or $12 a share. The company is a goodish quality one, 69 quality, pretty good. We haven't got a peg ratio because they had losses this year. Everything else looks pretty nice, actually, from a playbook point of view. From a valuation point of view, I plugged in the numbers. So what I've done is I put in the new numbers for next year. So it's about in the mid, $11.50 per share is about the midway that the company forecasted. So it's a lot less than the analysts expected. So it's showing a loss, which people who follow us a lot know that we don't particularly like buying companies where the earnings per share drops from this year to next year. Even though they say, yeah, we're going to get better next year, then I still don't believe them. There is some upside in the stock, but 14%, the analysts say. But yeah, with that drop, we don't really like it too much. The market has punished the stock for. Well, actually, I was in it in 2024, I think. Um, and yeah, somewhere around there, I bought it, came out just as it dropped below the 50, but it's been in a downtrend ever since. And it's something we need some convincing to go back into.
But what about Carlsberg then? Let's bring up Carlsberg, and then let me kick in a little round football, because no matter what, it could be that Denmark didn't qualify for the World Cup. We know, um, per definition, a lot of people watching football and are going to the US, going to Mexico, going to Canada to see the World Cup. Ain't that just prime for beer drinking?
I think it probably is, but we we often, they've got a big market, Carlsberg out there. Royal Unibrew have as well. So we tend to look just at the numbers the analysts are putting in. The analysts have known that the World Cup's been going on in these regions for quite a while, so they've been able to set their estimates correctly. So here, look at Carlsberg. Carlsberg actually looks really, really interesting. It's got a decent quality score. The earnings are going up, and the PEG ratio is really, really good. It's below 2.5, it's well below 2.5, which is what we like. So there are a few other red areas. So these are the returns it gets on investing its capital and running its business, which have gone down a bit, but they're not too bad. I can forgive them for that because their free cash flow generation is great. When we look at the valuation, we can see it's bounced. I haven't actually changed my settings on here for quite a while, so it's actually bounced right on the red line, on my bear case line, which is quite nice to see. And we can see here that I reckon just this year, we're looking at a 20% upside in the worst case and a 60% upside in the absolute best case. If you hold it to next year, it's even better, just out there. So from a valuation point of view, it's undervalued as well. We just need it to get up above the 50-day convincingly and go up. You can see the MTI, so there are momentum indicators down here. They've gone green on the daily, and at the moment, the weekly for next week is going to go green as well. So we've pretty much got all the signs there to say Carlsberg could be a screaming buy right now. If I just very quickly look at Royal Unibrew, actually a better quality company. Everyone likes them. The analysts dropped by 0.5% in the last 90 days, so it's not too bad. They suffer as well from the returns aren't quite as good, but the free cash flow is great. They're at the lower end of the channel as well, not quite as much of a storming buy as I would say, or a storming undervaluation. So we can see a 9% maybe in the worst case, and maybe a 37% upside in the best case there. But and they're in a similar position. They need to get above the 50 days. So we'd probably lose 3, 4, 5% of that as it sort of gets into that uptrend. But the MTIs aren't turning green at the moment, so they're not having quite as good a time. So Carlsberg's the one to watch there.
And again, I find it very striking that both of them look super similar, both in their trading view, in their day to day, and in that they bounced on their lower case scenario, both of them. But coming from beer to diabetes, that's what, look at the segue we did there, because that was really something. 190 billion diabetes market is set to explode. That's a headline that I grabbed right away. And of course, it also said Novo, and it said Lilly. The two competitors are going at it again. But why is that market all of a sudden coming back into focus? Because Liam, let's face it, that's not a new market. Why the new headline?
It's not a new market. The new headline, the FDA last year. So while these drugs were being put out there for weight loss, they were deemed to be shortage or in shortage. And that's a specific FDA term out in the States that says that other drug companies can copy them and produce the drug themselves while it's in that shortage condition. At the end of 2025, it came out of shortage. So the FDA put an announcement out saying basically these companies couldn't manufacture the drugs anymore. So effectively, they've lost some competition out there, and that's what one of the banks, I can't remember which one it was, came up with a research note just saying actually there's quite a lot of upside potential in there for the market, because now there's only really two big players you can get these drugs from.
Let's look at Lilly then, because we always look at Novo, so people know what that looks like. But let's look at Lilly. Is there an upside to be had?
Yeah, I mean, I'll just go very quickly on the Novo Nordisk side of things, just on the valuation. It is really, really undervalued, but you've got no idea sort of when that knife is going to stop dropping. So it's something that we'll stay away from until it starts turning around. But there are some really good upsides there. Eli Lilly on the other side, incredibly high quality company. I won't even go through the first point of the playbook because it's such a good company, and everyone pretty much knows what they're doing in this market. And certainly you Danish guys with Novo. When you look here, I mean, the analysts seem to have quite a low expectation on the company. They've got a PE of only 28, and if I just look here, the average for the last 20 years has been 30. The average for the last 10 years has been 42. So unless the market is, the bottom is going to drop out the market, then I don't see the analyst PE ratios being correct. So this is where we can justify us saying, even at this point, where again I haven't changed these my lines for quite a while now. I drew these in a few months ago. You can see it's bounced on the red line. Is now starting to follow up on my bear case. So that means in the worst case scenario next year, that stock could be worth 61% more than it is at the moment, or it could double.
Really quick question before we head to the tech side of it, because
Yep.
this Thursday on Novo, the PE, is that similar to Eli Lilly, and is it comparable for them?
That is a very good question. I didn't look at that. So the PE that the analysts are saying is 15. Which is fairly insane, I think. But yeah, for a company is important. So the average over the last few years has been between 24 and maybe 30, something like that. And we've got 24 as our base case that we think is actually going to happen, and the worst case at just 12 there. So even at 12, there's a 37% upside. So I can't see a world where we're not going to go into Novo at some stage in the next year or so, but when that's
We'll
going to
wait.
be
We'll wait
really
for
depends.
the big elephants, as Henrik always
Yeah,
say.
yeah, we'll wait till it goes up here. You can see here, this is what we're waiting for. It's used the 200-day and the 50-day as sort of bouncing points to bounce back down again. It's been refused every time until it meaningfully starts going up. We're not going to go into the stock.
And the same for Eli Lilly. If we bring up that you were just there, I know that
Yeah,
I ruin everything
you,
by asking that
you do.
question.
It's
So
nice of you to actually admit it,
yeah,
though.
I
So
know, I
that's
know,
cool.
I know. Why not? But that looks a little bit better. It looks like it's more ready to cross the 50-day.
Yeah, it certainly looks like it might have bottomed out, from the current sort of I think you could call it a range trade that it's in at the moment. Sort of so once it gets above this level, maybe bounces down and then comes back up again. That's when we get particularly interested. And because it's such a quality company, because there's so much upside, then it's something that we will just buy. And you often see this time where the market's gone up, from the August 25 all the way up here. It tends to have to spend some time digesting its food, which is quite ironic for an
Yeah,
obesity
yeah,
drug
yeah.
company, until the investors are ready to actually say, yeah, okay, we think we're ready to buy some more now. We think we're ready to follow that back up. But all we're doing is really following the earnings per share multiplied by the PE ratio we think that the investors have paid in the past, and that comes up to a much bigger number than it's at the moment. So it's maths and logic.
Yeah, we had a really good connection between the beer and the obesity thing, we thought. So I don't have a good one now, but we're gonna have a Tech Thursday, because there is basically gigantic news, and I'm surprised it's not making more headlines everywhere, because Meta came out and debuted an AI model, and they are rivaling. They are really finally showing what they've spent billions and gazillions of dollars
Don't
on.
know.
Really.
I haven't even looked up how many billions, but actually the link is chips. After you've had beer, you go and have chips,
Okay,
don't
there
you?
you go.
So
There you go.
that's what we do anyway. So if we just switch over to Meta very quickly. So effectively what they did, they came out with a brand new AI that they've been working on for 6-7 months, and they have spent untold billions getting people in there. It actually sounds quite impressive what they've done. They've built an AI that pretty much rivals the top Gemini models and ChatGPT and Anthropic, but they've also made it much more efficient because they've started doing it on their own chips that they've been manufacturing, which is hence the chip side of things. But effectively, Gemini were very, very efficient in the first place compared to all the others. ChatGPT is sort of a bit of a monstrosity, and so is the Claude Anthropic systems. So they use a lot of power to generate tokens, which is how this stuff is measured. And what they've done, so Gemini tends to plow through about 18,000 tokens per watt of power. Facebook have been able to do it, and Meta have been able to do it for 24,000 per watt of power. So it's an extra 33% efficiency that they've got from there. And we've been saying for quite a while now that actually the winners out of AI are the ones that are going to get more efficient with their infrastructure. They're the ones that are going to be able to pass more tokens through. They've just taken down their internal board, but they had a bit of a gaming board on who could use the most tokens in any one month. And I think the highest one that was before it was taken down was a run rate of something like $43 million per year of tokens that just one developer inside Meta would be using to do his day job. So yeah,
Wow.
it's quite a large number. Meta itself, from a playbook point of view, incredibly high quality company. Earnings per share is expected to go up and up and up as our revenues. It generates free cash flow even with the amount of capital expenditure it's doing at the moment. So the free cash flow is after capex here, where they're spending hundreds of billions over the next few years to produce this AI stuff. So it's a high quality company, which you would expect, and the opportunity is there as well. I mean, just looking at the numbers here, again, I haven't touched my settings for quite a while on Meta. I think this year I haven't really touched it, and I drew in these numbers at the beginning of the year, and this is where it's bounced. So probably I should have been looking more closely and maybe even sort of bought it. But so the opportunity here for this AI, because it's so important, it's not necessarily going to be a hugely customer facing AI initially. What they're going to do, and what they've done very well with their previous systems, Llama, was integrate it into the ad side of things, and that's where Meta make all their money. And if they can get more efficient and more intelligent about placing ads with people that are going to be looked at, then they're going to make more and more money. So that's why the market's going to be quite excited. They were up 6% yesterday, something like that. They're not quite above their 50-day moving average to be of interest to us, and the MTI is still red on the weekly, but certainly something that has big upside when it does explode up there.
Could it be that 6%, of course, is very decent on a day where those two digits up
Yeah.
there, is it really getting squeezed by other news, and that's why they haven't had the love? 6% still good, don't get me
I
wrong.
th- I think the market will probably more wait for the numbers coming out, because it's very much, if they can make more money with the ads from this, and they already make a huge amount of money, they're one of the best out there at doing that, then that's when the numbers will start adding up for investors and they'll start piling in, I would suggest. So it's not about how sexy your AI is. They're one of the few companies that can actually say, we built this AI and this is the return on investment we're starting to get from it. And that's probably music to most people's ears, because up until now, who knows when the return is going to come for most of it.
And that's really what it's all about, is sort of pleasing those investors. And if you had $10,000 and you kind of evenly invested them into the S&P 500, that means the 500 biggest stocks in America, this is the top 10. You will basically spend $3,861 on the top 10. That's about 40% of your entire investment spent on the top 10, which means that you have basically 60, or you have 60
Yeah.
dollars left for the last 490 bucks. Liam, we're not going to teach people anything in regards to buying a fund or an ETF or anything like that, but that's an awful lot of money spent on top 10, isn't it?
It is, and it's something. You look at the Nasdaq, and it's even more skewed. It's because it's market cap weighted. It's called the index. Then you get the bigger companies are better represented in there, are more represented because their price has more weight, and that's how it works. And it's the only really logical way of doing it. We're actually recreating some of these indexes internally in the MyStockScanner system, and it's the only logical sort of approach that we decided to take. The Dow Jones isn't. The Dow Jones is equal weighted. So yeah, that's just a different old-fashioned way of doing things.
It is, and it's also about the question about temper, how you want to do it in that sense, if you want to buy single stocks or you want to be in an ETF. See, that's our show for the day. I know that we have interesting numbers coming up later today, PCE, jobless claims, and then we have CPI tomorrow to talk about in our show Friday at noon, and Hans Henrik will be back for that. Liam, you're going to be back on Tuesday, and of course, always with tech, and there will be a tech article out there on our platform that you will
Yep.
get to have. And that's, of course, one of the benefits about being a member of MyStockScanner.com. If you're not already a member, do take us up on our free subscription. In that sense, you get a month for free. You get to look into the portfolio, you get to look into the playbook, and you get all the articles that we produce in a day, including the market scan, which is up for today, even though that Hans Henrik didn't do the show at noon today. He will be back tomorrow at 12 o'clock. Liam, I'll see you next Tuesday at 1 o'clock for Tuesday Tech. Have a good one and happy investing out there, guys.